For years, banking as a service was sold as a silver bullet for community banks to solve their deposit problem and grow non-interest income. The introduction of technology and service providers sold as a story of maturation and orchestration that made it easy to enter the business. Well, did that actually make it better? After all, banks are good at risk management. They manage risk all the time, but are they really in this channel relationship? Then Synapse went bankrupt. Consent orders were piling up that banks that thought they'd outsourced the risk along with the plumbing. And suddenly every sponsor bank needed to prove, not claim, prove that they actually control the work. The new paradigm: orchestration, control, observability. Each stage is a natural step in the maturation. Synctera, with participation from Alloy Labs, outlined this in a white paper you'll find in the show notes. This isn't a marketing piece. It's a blueprint for the choices a bank that wants to play in sponsorship banking will need to make. Next week, we're hosting a very different event where 5 different players will present an Amazon-style white paper on how their part of the ecosystem could and should work. Not marketing speak, not roadmaps. Special thanks to Alloy, Infinite, Cobalt, Move, Spider, and Synctera for putting aside egos to share insights that are fundamental for the industry. And this wouldn't be possible without our partnership with Brock Farazano and Crow. For those not attending, here's your first look. This week on Breaking Banks, Jason McCullough, who wrote the book on BaaS, like literally it's on my bookshelf, and publisher of FinTech Business Weekly. Ellen Lenardi, Chief Product Officer and Technology Officer at Synctera, and Reed Whiting, President of Lincoln Savings Bank, join me to talk about sponsor banking. Are we growing up or are we catching up? So BaaS has been around. Jason, in your book, how long did you track back? When did you actually say the beginning of the banking as a service era began?
I guess I would say the sort of most recent or contemporary wave, I would date to like the mid 2010s. So around the time you get, yes, your Synapse, your Treasury Prime, your Unit, your Synctera. So that kind of like 2016 to 2019 landscape when many of those companies were founded, and then the really big wave of startups that were built on top of them, kind of 2020, COVID, money is free, zero interest rates, everything is online forever, is kind of how I think about it. But of course, everyone, on this call no doubt knows that the origins of what we call BaaS, or banking as a service, go much further back to the prepaid card space in the 90s and all that.
Well, we're in the purpose of this show and to begin to dissect is the re-architecture that goes on, right? If we think about the early era, and I would say, let's use that model. So like for Perk Street and Simple, we looked at what had happened with prepaid and said how they organized and said, there's a fundamental flaw in how they work because those deposits cannot be lent against because it is very much an arm's distance transaction in how they're being held. And we said, we think if we actually integrate from a compliance and account ownership perspective, those becoming accounts of the actual bank rather than an arm's distance program, you can actually lend against those. And then in 2010, we're like, there needs to be more integration. And as Ellen will explain here shortly, we're now in a re-architecture. I want to start with something, a little bit of a hot take of we're seeing this re-architecture. Is it really being driven? Is this a maturation? Is it something because we have more feedback from the market and that market being largely consent orders from regulators? Or are we seeing this because we had the blow up of, that other orchestration layer, that completely imploded with tens of millions of dollars kind of still lost in limbo and, people doing the Spider-Man meme pointing at each other saying, you're responsible. No, you're responsible. I'm not responsible. You're responsible. But, Jason, why don't we start with you? Like, why are we now at this moment that we're actually seeing a lot of the re-architecture begin to take place?
I mean, I think it's a little bit of a lot of different things, right? So, I mean, yes, there is the elephant in the room, the Synapse disaster. But, it is worth pointing out that while hopefully folks in our industry across the board, so banks, but also, whatever you want to call them, technology service providers or middleware platforms and customer facing fintechs, one would hope that, people observed this, and even absent statutory or regulatory changes, were like, "Hey, this was really bad. We should probably try to not have that happen again." That said, there have been smaller programs that have failed in what I would describe as like a not very customer friendly manner. Small ones, right? There's a consumer one called Cube Money, which was kind of like a envelope style budgeting thing, and then more recently, SMB charge card startup Parker Card. So it's like, even though we've had a large scale disaster, and hopefully people saw that and learned lessons from that and changed practices, clearly there are still potentially issues, beneath the surface with how some of these programs are run. And we also have to remember, like, the competitive environment now in 2026 has become very, very different than what it looked like 5 or 6 years ago. You've had the rise of what I sort of think of as like the BaaS native bank. So your Cross Rivers, your Column, your Lead Bank, explosion of stablecoins, which all sorts of startups are now opting to build on this like stablecoin infrastructure instead of maybe 5 years ago they would have picked one of these middleware platforms. So it's a very different environment in a lot of ways than it was 4 or 5 years ago.
Now, Reed, you've been on all sides of this, both with Five Star and with Lincoln being one of those banks that was in relatively early. And you've done all sorts of combinations of both working with infrastructure providers, bringing in your own and integrating your own infrastructure, working with Synctera. Like, how are you viewing this evolution? How are you beginning to make those architectural decisions?
So I think this space, like many others, there's been a transition from and a swing of the pendulum on the pros and cons. From if you build it yourself, there's a high startup cost and a slower time to market, versus if you partner with a technology provider, lower upfront cost, quicker time to market. But given the evolution and maturation of the space, I think banks are thinking critically at the current time about their tech platform and infrastructure, and thinking what may be the best for me 5 years ago may not be the best for me 5 years from now. And how can I think about that not just from a commercial perspective in terms of how I can most effectively source new partners, generate deposits, acquire end users, but also play the game of keeping pace from a regulatory risk management, compliance, control framework. And how can I, in the same way I have done from a commercial perspective, lean into technology in that space to make sure as I grow, as I scale, I continue to achieve prudent outcomes consistent with regulatory board expectations, et cetera.
So, Ellen, I'm curious with your perspective, not being a banking native, how have you watched this evolution? And now you're leading the evolution so much for Synctera.
Yeah, I think, just from a background perspective, I've been in cybersecurity, healthcare, right? A lot of heavily regulated industry. And to Jason's point, if this started in 2010, 2015, this is still a really young industry compared to many other, if we think about like manufacturing, cybersecurity, and all this stuff. So I think the evolution is a natural progression of unpacking the next bottleneck, right? Like when all of this started, like connectivity and just ensuring that you can integrate from a processor to a bank to a non-bank who's trying to like launch some of the service are so hard. So Reed, I'm sure you felt a lot of this, the majority of the conversations, like how do we solve this connectivity problem? Right. So all the solution initially, Synapse included, was about connectivity problem. Then once connectivity is done, they're like, yay, ready, let's go. Like everyone launched it, not realizing that, wait, the control that used to exist for banks before, where it's a single system, now no longer works because there's distributed system in multiple places. So then everyone start putting the control in, right? They're like, great, we need policy, we need this rule and everything else. And then you realize once you put all the policies in, you're like, wait a minute, like the policy's in, but how do we actually know that it's working, right? So to me, kind of looking from the outside, it's almost this like natural progression of maturity of the industry and unpacking the next bottleneck and the next bottleneck. And, maybe my bias being more of a product person and an infrastructure person than anything else is that it led us to see that what needs to happen is not just the orchestration and the control itself, but then how do you observe that the control in fact is happening? Because we need to also have confidence that the system and infrastructure is performing as is expected without blowing up with headcount, without having insane amount of like manual controls over it, right? So that's kind of how it to me, I think it feels from the outside.
Well, in that natural progression makes a ton of sense, right? You go after, the closest fire that needs to be put out first. In this case, it really was the connectivity. And, APIs, sadly, are still relatively novel within banking, but we're all getting there. 20 years ago, 10 years ago for, the onset of the Syncteras and Treasury Primes and units of the world, most banks didn't have those, couldn't support them. So you absolutely needed that middleware layer to even have the data move. And Ellen, I'd love for you to lay out the framework that you Synctera has put together in the white paper around the future of how you view the architecture and the elements that go into that.
Yeah, and I think of it as like the 3 dimension of sponsor banking as we see it today, right? And so I'm saying that because it might evolve again as we mature further in the future. But, you start with the orchestration layer, which is all about solving connectivity. Like, how do I launch programs to begin with? And then once you go through the launch phase, then it's really about governing the program, right? You need control, you need limits, you need to be able to do the right policy and rules and everything else. And that's kind of the layer of control that I think every bank needs to define. And then this kind of third layers that I think is maybe somewhat of more of a unique, at least, approach that we're seeing is this concept of like observability, which is how do I know that the control that has been set up in fact is doing, right? I think this is the phase where it goes beyond policy into actual operational confidence, right? And part of what we've seen in working with many of our banks it's not that there's no validation or testing or anything today. There is. It's periodic. It's manual, right? The data is all over the place. It's hard to do. It's expensive. And maybe the more novel concept is to say, shouldn't observability actually be a continuous operational process as every transaction pursue, right? Which is also part of what made the cable acquisition really interesting for us when we were looking at it, is that how do we extend not only operational control, but the observability on an ongoing process to understand that the control is in fact doing what's supposed to do. Right? It doesn't make you safer. It just allows you to catch things better. Right? That's kind of how I would think about it. So,
well, better and faster. Reed, I'm curious, how much emphasis are you putting on today this idea of continuous monitoring, what Clayton Mitchell at Crow likes called like the surveillance nature as opposed to the audit nature of compliance? Are you driving towards that 100% visibility and testing?
Yeah, it's interesting. I think as Ellen was speaking, I would phrase it maybe observability by another name. So I think quality assurance, testing, monitoring, et cetera, has always been there. And whether that resides in the first line or second line or a bit of both, different partner banks set it up differently. But I think what Ellen's saying is with the evolution of the technology and banks' ability to ingest very granular data and manipulate that however they want it at whatever levels of granularity, we can more effectively step up our game in the assurance space to have more intense, I would say, monitoring, but also more frequent, right? So things that used to be done monthly, quarterly, annually, maybe because that was the agreed regulatory framework or consistent with your risk appetite, or there was a real resourcing consideration associated with the time it took to do it. We can now gain that efficiency through the observability that Ellen's referring to. And I'd like to think there's not just an efficiency play there, but probably also an effectiveness play in that it's more automated, and then you can have kind of humans overseeing it, but not necessarily doing the work in some manually intensive way.
Well, and I think, to get to some of the points that both Reed and Ellen have made about maturation and evolution of industry over time is this is fundamentally different. So, I mean, one of the ideas that I talked about recently with our industry colleague, Kia Haslett, and Professor Dan Alry was sort of the inversion. I think Dan described it as an inversion of the value chain in the sort of fintech or a banking as a service type relationships, right? So banking has had third-party service providers or vendors for a long time, but typically the customer-facing relationship was still owned and operated by the bank. And maybe you had, a Fiserv, a Jack Henry, FIS, bunches of other vendors under the hood. But there was, to use a terrible but I guess appropriate pun, there was a choke point, and that the bank had control and visibility over the vendor relationships under the hood and the customer-facing interactions up front. What we've seen with so much of fintech and so much of BaaS is that customer-facing relationship is now outside of the bank. And so to do whether we're calling it continuous monitoring or QA or observability, it may not actually, in most cases, I'd argue, probably is not the bank that is sort of the first line of that relationship anymore. And so it has taken, I think, time and, some unfortunate consent orders to sort of understand, hey, the nature of this operating model is different, and by extension, the risks this operating model or these operating models pose are different, and we need to adapt and retool both, processes, policies, and procedures, but also technology in order to effectively monitor and mitigate those risks.
Well, and that's been a position for Lincoln Savings Bank, almost since the outset, and certainly before, the Synapse collapse, was always that the buck stopped with the bank. And that's something, that I've enjoyed most in a lot of the interactions is, disclosure. Lincoln Savings is one of Alloy Labs' founders and one of the founders of the BaaS Center of Excellence. But that is something that, was brought to the table even predating you, Reed, right? Was this level of ownership that it doesn't matter the program or the vendor that we can be using for technology, the buck stops with you. And Ellen, I think I'd love to have you expand, because one of the core principles in your white paper is around who owns the ledger and the data and the ultimate responsibility attached to that, right? Like there's an interesting intersection where technology is beginning to drive policy attached to that.
Yeah, I think, ultimately within is the bank's charter, the bank is responsible, right? Like I don't think there's an if and buts around any of who's ultimately accountable for that. I think the question is what's the expectation of the infrastructure programs and sort of technology to make that job of continuing to meet their responsibility easier. Right. So I think it's much less so about shift, like the responsibility cannot shift from the bank. The bank needs to define their policy. They need to understand their risk level. They need to know how the risk level is being performed against the control and whether it's still matching the profile of what they're envisioning to begin with. Right. And every organization is going to have a different risk appetite associated with that. Where I would say technology provider, infrastructure players like ourselves comes in is in facilitating and making that task easier for the bank, providing the visibility, taking all this fragmented system and doing as much as what a technology and infrastructure can do to facilitate that. And I think in some situation, partner with the bank to help our fintech, our non-banks actually understands the policy, right? Like bridge a little bit of what sometimes I call unnatural union of like a a non-bank fintech who's trying to move super quickly. They don't understand regulation or anything like that. And then a bank that maybe is new to some of this industry, right? Like they don't really know how rental market works. They don't know what this prop tech is trying to do, right? So our role, I think, is very much in, I think, number one, supporting the infrastructure and technology platform. Secondarily, to help sometimes translate the vocabulary difference that exists within two very real like world and ecosystem.
I want to emphasize something that Ellen mentioned that I think is also a big change that we sometimes kind of gloss over. It's like who's doing the building, right? And the kinds of entrepreneurs and startups in call it the 2015 through present wave, I would argue looks materially different and thus has a materially different context and knowledge base than maybe somebody who is building it, before fintech was a word, but somebody who was building in the space, 10 years prior to that. And so I do think, again, it has taken time for each stakeholder in sort of the current operating model to understand, like, hey, I agree, 100% agree with Ellen that like the responsibility ultimately sits with the chartered entity, right, with the bank, but then to actually effectively operationalize and meet those regulatory requirements, every player in that relationship, whether it is a technology service provider, whether it is a customer facing entity, whether it is the underlying bank or some other third party, they all need to understand like how are we supposed to work together to meet what these requirements are, and that I guess implicitly like presupposes that everyone understands enough to be able to fulfill what the obligations they've taken on are.
I think there's a value chain here, right? So you have the partner owning kind of the user experience and facing off with the customer end user, and I refer to them colloquially as the zero line of defense. And it's okay. And then you have the technology layer, and then you have the sponsor bank, right? That's providing the banking products and services, but also on the hook for all the regulatory stuff. So as you look across that supply chain, there's roles and responsibilities. So who's doing the thing? But then there's monitoring and oversight. And how can the bank get itself comfortable if it's not doing the thing, that whoever is doing it, whether it's the partner or whether technology, to your point, Ellen, is facilitating whatever's happening through data or the UI or otherwise, how does that all hang together such that you have comprehensive and prudent coverage that you can go back to your regulator, to your board, and confidently say, we're good, we got this. And then to one of Jason's earlier points, I think there's certain things, right, that are kind of sacrosanct, whether that's reconciliations, whether that's transaction monitoring in the BSA AML space, et cetera, that even if you have some type of filtering mechanism and that the partner or the technology platform is doing that as well, that the bank isn't going to fully outsource that. And they're going to take ownership of it and make sure that they trust and verify on their side.
Well, and there's an interesting quandary attached to this, right? That very much in the early days, this was done within the confines of the normal bank. In fact, LSB, when it created LSB, acts kind of as its own set of practices and excellence and its own risk people attached to it, as you were scaling. That degree of specialization, in part because the technology did get better and the likes of the Syncteras that said, oh, it's easy to get into the business. You saw a lot of banks just saying, oh, we've got a charter. We're good at risk and compliance because we do that. Because we have this technology provider, we can get into the business. But now it's become ever more specialized. And even though there's better, more powerful tools like Ellen was talking about, is these more specialized tools actually require more specialized people. Right? Like, is the technology actually saying that, hey, you shouldn't just be getting into this business as a source of deposits or others. You need to be a specialized operator. Sure, you can fly a prop plane. We're talking about a rocket ship now.
Yeah. I'll share my thoughts, and then Reed, I'm sure you have yours as well. It's interesting because I do think that, it is a distinct mindset than operating just like a retail banking, right? And prior to Synctera, I was at Clover and then by proxy Fiserv for 9 years, right? So there's a lot of exposure to regional community bank merchants and everything else, but each one of them requires a very different mindset of thinking about the relationship with the partners, right? The first line of defense, right? As you were saying, right? Like the folks who are creating the experience, what they're trying to do, and all of those stuff. And I think the technology simply gives you the tool. The mindset of the operators within the sponsor banking program, right? Whether that's on the compliance, on the business side, on the relationship, are distinctly different mindset than others. So, the technology doesn't automatically make you successful at all. It gives you better tooling. But I think the distinction between one sponsor banks and another, and we've been in relationship with many of them, is really the alignment internally on the risk approach, on how you think about the business and how we engage with our partner. That by far, I think, is the bigger distinction I see amongst various sponsor bank and how they approach the relationship, more so than just what platform they are utilizing. I guess both are important, right? Both the technology operating model, but the mindset on its own, I think, is a huge component and a super important aspect of how banks enter sponsor banking.
Yeah, we just picking up on that. We talk a lot about logical separation, which is, okay, you have a fully dedicated line of business. That's awesome. But really what's going to make your business hum is all the support and control functions. So whether that's operations, whether that's risk, whether that's compliance, BSA, finance, et cetera. So how do you have some degree of resourcing within those support and control functions that even if they're spending part of their time on the traditional bank activities, have the mindset and the prioritization and the discipline and wherewithal from a commercial perspective to really lean into the technology and use it as effectively as possible, and making sure that across the lines of defense internally, there's a consistent strategy there in order to really unlock the value and deploy and unleash the technology as it's intended to be used.
Yeah, we've also seen a change in how many of the banks that play in this space and many of the technology service provider intermediaries in the space sort of organize the work. I mean, I don't want to revisit the direct or not indirect battles of whatever year that was, 2022, 2023. Yeah. But, some of the original approach to operating these partnerships sort of implicitly, if not explicitly, was like, hi, like I'm the middleware firm, I'm the technology service provider. Like dealing with the bank is a pain in the butt. Like not only is their tech bad and they don't have APIs, but also there are all these compliance hoops to jump through. There's all this onboarding. There's all this vendor due diligence. I'm going to sit in the middle of this relationship as not just a technology intermediary, but also functionally like a program manager intermediary. And I mean, I think fairly resoundingly like that, not that model couldn't possibly work, but I think that something like 15 or 20 consent orders plus, Synapse demonstrate that in practice, it was not a very successful way to operate these kinds of partnerships where there's sort of a wall in between the regulated chartered bank that has ultimate like legal regulatory liability and the customer facing programs. And so we've seen that change as well, where it's like, hey, if you're the bank partner, you can't just assume that some intermediary is checking all the boxes, following all the policies and procedures, and ensuring that they're actually doing what they're supposed to do. So we have seen a change in that regard as well.
Yeah, and I think to maybe one of the original question, that's probably where this concept of observability and proof actually for us becomes incredibly more important, right? And Jason, I think in some ways, maybe it doesn't matter as much who's operating it as much as that it's well-defined. Someone's operating. You can prove that, in fact, somebody is operating it the way the control is defined, right? And so it's been an interesting evolution that I think earlier, as the industry was changing, it was a lot of there's a lot of like terminologies that I think has been thrown out. And, Jason and I chat a little bit about this, about like FBO is bad. I was like, well, why exactly is FBO bad, right? Or is the program management bad? Like it becomes terms that are considered not good because it's not clear who's responsible, what they're responsible for, and there's no way to prove that what is supposed to happen is in fact there, right? So the way I would think about it is more on like a capability to the roles and responsibility to the actual validation and how the entire chain can actually be proven. And having an operating model that's sound is probably the most critical thing, regardless of which mode a sponsor bank choose to do, right? Because I think some sponsor banks choose to go down a program management path, other decide to do a direct banking as a service, other build their own technology. It doesn't change the fundamental component of the operating model that any successful sponsor bank has to have as from an architectural perspective, I think. So.
I love that you harken back to our very first conversation, Ellen, was the introduction of like, Jason says FBOs are bad. Go talk to him. They're not bad. They just come with a series of complications. And
Correct.
I think I want to underscore the point you just made. And I think this is part of the new era that we do have greater data availability is with clearly defined rules that observability and provability does actually make it easier to say, hey, can we actually go back to an era where I don't want to say you outsource, but you can be using third parties, right, more frequently because you don't have to be doing the work to have control of the work. Reed, that's where I think you were going before with this is I can actually still own the outcome attached to it, even if I'm not the person doing it. And that's very different than, the eras of 2010 when it still was so manual.
Yeah, I think it allows you to get on your front foot a little bit when you're going to a regulator or to your various governance forums to say, we got it, and here's how we know we got it, because it's empirical, it's objective, and we have the data to prove it with the requisite controls around that. And like anything else, if not well defined, if you don't define it for yourself, someone else will define it for you. And it's unlikely you're going to like that outcome, because it's probably going to be you need to do more or you need to do different. So, controlling your own destiny, leveraging the data to your benefit is really what we strive to do.
Now, a topic that keeps coming up, and we didn't address it in the white paper going after this, but I think it is worth, discussing is we will hear, or I maybe more accurately should see, because this is what Jason and I send each other back and forth with our little chat group, the, people on X saying stablecoin changes everything attached to this. Ellen, why don't we start with you? Do you think stablecoin fundamentally changes the architecture again?
No, I think stablecoin's still going through a place where the regulation hasn't quite caught up yet. But by definition, you're holding custodial money on behalf of customer. You're going to move some money that needs to be regulated. And like eventually, I think it will get there. The regulated entity might shift over time depending on how the policy lands, right? But what needs to be regulated, and if I step back on why regulation's there to begin with, we do all of this stuff to ensure that at the end of the day, the consumer who've entrusted their funds, right, to bank as an entity is not going to be left out there to suffer, hang on to the loss and whatever it is. So from a principle perspective, my expectation is eventually, whether that's stable coin or the next revision of how we can move money outside of the established architectural path that we have today, are going to have to answer the question of how do you ensure that the end user who are entrusting their fund are actually protected by the system that promises to them that they will do so, right? That's kind of what the fundamental of banking is, and these are just different revision of it. And so I think stablecoin is going through the early days where it's not yet regulated. People are working around lack of policies and skirting through those areas, but fundamentally, I think we're all in the business of some amount of like facilitating custodial funds on behalf of consumer and moving money for consumer, and the fundamentals of what needs to be guaranteed in those situations, I think, doesn't really change, right? Like how you do it and how complex it becomes, and technology that needs to be there to match it might evolve, but I don't think the right thing to do for the end user really shift. It's just whether or not the regulation has caught up yet.
I mean, I would tend to agree with Ellen at a conceptual level. Like, ideally, like what she's describing, hopefully, is how things actually develop and operate.
Eventually.
But even as you were saying the word custodial, though, like what popped into my head that I've seen like a material number of examples of, and this is not just stable coins, but also sort of broader, like other cryptocurrencies, like non-USD or non-peg cryptocurrencies, is what I perceive as, or what I would argue to be, a regulatory arbitrage where you have firms saying, no, we just make software and you have a self-custodial wallet. So like, yes, my company is based on some small island off the coast of Madagascar where there is no regulation of anything. And all we do is make software that allows you to use your stable coins in your self-custodial wallet to do XYZ. And I mean, again, Ellen, to your point, like right now, I feel like that pretty clearly is a regulatory arbitrage. Do we see that converge over time with the kinds of basically achieve something closer to parity with like, hey, just because you're calling this a stable coin that allegedly the user is holding him or herself, as opposed to it being held in by a custodian or as a bank deposit, like I always, at least at a conceptual level, go back to like same activity, same risk, same regulation.
Yeah.
And right now, I do think there is some arbitrage or some divergence.
Yeah.
What that looks like 1 to 5 years from now, what it looks like in the U.S. versus in Europe versus some other jurisdiction, I think there's still a lot of unanswered questions.
Well, and this becomes the challenge when we get into the speed sort of things, right? Like it comes up repeatedly that it's like, oh, we're faster, we're more nimble. Often faster and more nimble means we're cutting corners, we're, taking advantage that regulation has not caught up, with these pieces. Reed, I'm curious from your perspective, right? Because Lincoln has such a great reputation now, but you don't compete on speed, right? But you still get some of the best programs out there. Are we finally past the era of hearing programs say, oh, we're like the Uber, we like to move fast and break things?
Go fast and make things work. No, I think we commented on this a little bit earlier, but this industry has evolved from being a small set of highly commoditized products and services to now credible, sophisticated, mature partner banks at scale want to be a full suite provider of a comprehensive set of products and services. Now, to say that is quite easy. To execute it is more difficult and takes time. So the way we approach that, Jason, is we try to go deep with our existing partners, which is to say, okay, we already offer you widgets A, B, and C. How can you're a known commodity to us, we're a known commodity to you. If we want to now offer widgets D, E, and F, and there's a real demand there from our mutual customers, our mutual end users, so the ROI is clear, how can we stage that out over an appropriate time frame, make sure we're all comfortable with it to get to the right outcomes?
Ellen, as we round this out, how do you approach that question, right? Because you're in the middle. You both have the regulated entity behind it. And as Jason pointed out, you used to be the buffer to be that part that said, oh, we're nimble, we're a startup like you, we can move fast. How do you balance the tensions?
I mean, I think a little bit of the lesson learned on, kind of the BaaS space is you almost see what happened when like growth outpaces operational discipline on its own. Right? Like when you solve for growth first, like there's a whole bunch of mess that comes with that. And then the way I would think about it is like the innovation itself actually suffered because there's suddenly no trust in the whole system. right? And so I say a lot of the things that are a little bit more. When I came and joined Synctera, one of the things I appreciate about it, I was like, they do a lot of boring stuff, right? Like reconciliation, compliance. Like it wasn't about the cool things; it was about the boring stuff. I was like, doing boring really well and doing it right is actually important, and that's what allows us to unlock innovation. So the idea of even observability is that, in some ways you might think, hey, there's more stuff that we're going to have to do in order to launch a program. Like we're going to have to like enable the control, we have to define all this stuff. But when things are well defined, when boundaries are clear, people can innovate within those clarity of the boundaries a lot faster and safer, right? So the way I think about it is that there is a tension, but I think maybe not always the way we think about it, where the well-defined boundary and processes and all of this constraint limits innovation. Well-defined constraint can unlock innovation. Poorly defined constraint can limit innovation. And I think that's why I was thinking the moat itself is not so much of like having the platform or the technology. It's the mindset from the bank and the partners, and why like we really appreciate working with like Lincoln as well. It's like having the right mindset to define your risk limitation, who you want to work with, what it looks like, and be really clear with, the technology partners early on, actually allows them to then innovate much quicker. As long as you're operating with this boundary, we can measure it, we can monitor it. Let's go, right? So I think I would summarize it as like innovation requires trust, right? And banking requires trust. And when we run into a situation where the growth and just scale outpace operational control, the trust suffer, and that has a much larger implication on what the overall industry is able to innovate on.
Well, let's close on this as we talk about trust. And in a world that is moving faster than ever, how do we actually, in a world that, with fast moving innovation, how do we continue to instill trust, both to the consumers and the business customers that are leveraging these platforms? Rita, I'll let you start, and Jason, you get to bring us home.
I think transparency is key for us. Obviously, there's natural and frequent lines of communication, but if either side of the party thinks something isn't working quite the way we intended it, trying to be proactive and intentional about that has proven to be most effective for us. And to Ellen's point, there's different vectors of risk in this line of business. Choosing your partner is a key one. So if you have someone on the other side of the table who you can trust, and you demonstrate that over time, a lot of the other things we've been talking about today kind of go away.
Jason is the foremost expert on the Synapse debacle. The title you will never get to do away with. How do you think about the trust equation?
Yeah, that's what they're going to put on my my tombstone. No, I mean, I think we haven't talked too explicitly about like specific regulators, as in like who is in those roles at the moment. I mean, the piece of advice I would give is like, just because there is a perception, perhaps justifiable, that there's sort of a let's say looser regulatory environment right now, is not a get out of jail free card. Even to the extent that, maybe certain infractions or errors or mistakes, are never discovered and never enforced, that doesn't mean that those decisions don't potentially undermine trust in your customers, if you are a customer-facing product, and in aggregate in the industry at large. And I mean, Jason, I come from a customer marketing background. I mean, a really simple example / piece of advice is like, do what you say you're going to do. If you market your product really aggressively in a way that potentially could be deceptive, a user who's experiencing those marketing messages and thinks one thing, like, oh, I'm going to get 100% cash back. And then they actually use the product and they're like, wait a minute, you told me I was going to get 100% cash back, but I'm getting 1% cash back. Like, that is a very simple example, but also a very real, tangible one that I'm seeing out in the wild right now. So it's like, setting aside whether or not, the teacher's out of the classroom for a couple minutes, like, your customers are absorbing how you position and market the product and how you interact with them. I mean, another very quick example, customer service. I know that customer service is often viewed as a cost center. I can understand why that's the case. But you look at something like Built, where they went through a transition that, based on all empirical evidence, was very poorly managed. But on top of the poorly managed transition, customers couldn't get a hold of anybody about their problems. And if you want one thing that is going to break customer trust incredibly quickly, it's when you have a problem and you can't get a hold of anybody, a real human being, to help you solve that problem.
Well, and especially when we're talking about something really important like your rent payment for the place that you are going to live. And I think, bringing this to the close, we might be re-architecting the technology, and the technology is enabling changes to the roles and responsibility. But the one thing that is not changed, that's not being re-architected, is the importance of trust in this, trust with your partners, with your vendors, and the trust it conveys to those users of the technology. Like, that is the part that can't be architected away with new technology. Well, thank you all for joining me today. The white paper is available in the show notes. It is a short but very impactful read, and really love how Synctera had outlined this new framework for how you think about the architecture if you're getting into sponsor banking.
That's it for another week of the world's #1 fintech podcast and radio show, Breaking Banks. This episode was produced by our US-based production team, including producer Elizabeth Severance, audio engineer Kevin Hersham. If you like this episode, don't forget to tweet it out or post it on your favorite social media, or leave us a 5-star review on iTunes, Google Podcasts, Facebook, or wherever it is that you listen to our show. Those actions help other people find our podcast, and in return, that helps us build an audience that can be supported by sponsorship, so we can continue to provide you with our award-winning content every week. Thanks again for joining us. We'll see you on Breaking Banks next week.